Are things really looking up for the economy if the housing market is just now showing signs of turning? Torsten, Slok, senior economist at Deutsche Bank, says the main question is, when will home prices improve? Torsten Slok joins us now. It's great to see you.
Thank you.
So on housing, you wrote an extended piece on this recently. We are seeing better numbers on sales and prices, even builder sentiment here. But I guess the question is, how robust is this turnaround going to be?
Yeah, well, we'll look at it from the demand side and the supply side. And a lot of temporary forces are supporting demand at the moment. Most importantly, there's a tax credit for first-time home buyers, which has been very supportive for the housing market here in the last few months, which is about to run out by the end of November. And that's definitely boosting demand. But on the supply side, we're still very worried because there's still a huge excess supply of homes that we're waiting for to be liquidated.
Are there any other factors that could buoy the housing market once these initiatives wear out?
Well, one very important force is, of course, what the level of mortgage rates is. And mortgage rates and affordability more generally is definitely at a very good level at the moment. So that's definitely something that we're looking at very carefully. If the level of interest rates go up, that will certainly weigh on the housing market.
How concerned are you about the availability of mortgage credit, especially considering that the Fed is easing out of its MBS purchase program?
That's certainly something that's very important because at the moment the problem is that a lot of homeowners are underwater, and another problem is that it's difficult to get a loan. So overall, mortgage availability, there may be very low interest rates, but the problem is that many homeowners don't qualify for a loan, and that's definitely something that we're worried about on the demand side.
How many years do you think it's going to take to work off this excess stock?
Yeah, we estimate that the excess inventory, meaning the number of housing units that are out there, is about 1.5 million, and we're liquidating that at a rate of around 750,000. So that means that it could take up to 2 years before we liquidate the stock. That doesn't mean that home prices will continue to go down for another 2 years, but it just means that there's a big snowball of empty homes that we're pushing in front of us.
Yeah, and the interesting thing, Torsten, is that, you know, people talk about credit frozen up. The credit market still has not loosened to the point where people can actually get these loans. The credit qualifications now are much tighter than they have been in the past. How is that going to impact? When are we going to see a thawing of credit?
Yeah, well, things are moving in the right direction, you could say, because the banking system and credit more generally has definitely been improving over the last 6 months. But we need to see this trend continue because it touches on the general outlook for the U.S. economy, namely that we need to see two things happen. We need to home prices stabilize, and we need to see the banking system look healthy. And that's, of course, the risk that it's a very fragile situation, and in particular on the housing front, there's a lot of worries, as we just talked about.
Yeah.
I'd like to revisit the issue of inflation. Obviously, it's going to make mortgages more difficult to get, as you guys are talking about. But does the Fed want some level of inflation to reflate home prices and buoy the market that way?
It will be a difficult channel for the Fed to boost home prices that way. They probably feel that there are other instruments and other ways to help the housing market, in particular the purchases of MBS and holding down the level of rates. So the big issue, of course, is that once the purchases of MBS ends and once we get to the point where the Fed is no longer supporting the market, what will happen to the level of rates? And that's, of course, a worry that we have.
And when that MBS purchase program ends, when the Fed exits that, what's the landscape going to look like?
That's the big question, and that's, of course, the big issue that many investors are thinking hard about, that at the end of this, the question is whether there will be a natural housing market and a natural market in particular for MBS, which is not dominated by the Fed as we've had for the last 6 months.
That's like one of those things where it's over and the day after you throw your hands up and say, now what?
Yeah, and it's actually very similar to what we've had for the Cash for Clunkers program.
Yeah.
We had temporary boost to the car industry or auto industry for the last few months. The question is, what does it look like? And this will be a litmus test for what does it look like, what does the world look like without government support.
Did you see the foreclosure data today? Still huge rates.
Yeah, the good news is that in California it was coming down here, but the level is of course really worrying, and as usual it's California and Florida that where continues to be the main issue for us.
And it's keeping prices depressed, but isn't that good for first-time home buyers to get in on the market, or that doesn't help the broader housing picture?
It has definitely helped in the sense that foreclosures are a really important component in price discovery. Existing homeowners who don't have any need to sell are very reluctant to lower the price, whereas on foreclosures you have a very quick adjustment in prices, which is really what you'd like to have. But the problem is that we still have a significant amount of foreclosures. We could have up to 2 million foreclosures over the next year, and that's going to weigh and be a depressant for home prices going forward.
The interesting thing is, you know, before everybody was talking about subprime, but we're talking about prime mortgages as well. A lot of people, a lot of folks in luxury homes are ending up having to leave their homes either through foreclosure, they can't pay their mortgage. Are we seeing lots of instances now where people say, well, in order for me to keep my home, I will rent my home? Is that a last resort?
That's definitely what we see a lot, and that's definitely true what you say, that at the bottom of the housing market, all the cheaper homes, meaning below 300,000 or so, there's a lot of activity. But anything above 800,000, in particular anything above the Fannie Mae and Freddie Mac level of 729,000, there's very little activity. And actually you see the inventories go up, and that's of course a big worry, because we like to see clearance of the entire housing market, not just only for the relatively cheaper homes.
But that glut's going to be on the market for a while. If we're talking about homes over 800,000, even as we come out of this economic down cycle, you talk about a glut of homes, they're still going to be around.
That's exactly right, Mark, and that's the whole point, that we are saying, well, there was a lot of positive news this summer on the housing market, both on activity, on sales, etc., and home prices looking more stable. But the problem is that we still have a lot of things that we haven't worked through, and most importantly, the huge glut and the huge inventory of homes that we need to work through, and it could take quite some time.
What are the builders thinking these days, looking at the data, seeing some improvement, sales, as we said, off the top and whatnot? So are they breaking ground here, or again, you're talking about this inventory glut, it's like, why bother?
Yeah, well, the activity more generally has fallen 75%, so we're at a very low level, and we are seeing more signs of optimism in the sentiment indicators for the home builders, but it's from a very low level. So the good news is that the trend is starting to look better, but the big worry is that we still have these unsolved problems, that it will at least take another 6 to 9 months before we get through.
That's a dramatic number, 75%?
True. If you look at what has been the case, we have, for example, had that home building, or meaning residential investment as a share of GDP went from more than 6%, and now it's just above 2%. So as a share of the economy, construction of homes has shrunk dramatically. So that's really something that has been very important development throughout the slowdown over the last 4 years.
And we haven't even touched upon commercial real estate.
Yeah, and that's, of course, the other worry that's waiting out there, that the residential has dominated a lot in the news, but commercial real estate is something that we worry a lot about going forward.
So characterize the housing market as it fits into the broader economy right now.
Well, we are very pleased by the developments this summer and all the improvements. Some of it was because of seasonality, that when you go into the spring selling season, things improve. But we continue to have the main worry, namely the excess inventory and the number of foreclosures. And that's why we expect home prices to continue to go down until the first quarter of 2010. And stabilization in home prices is really important for two reasons. It's important for consumers, because then there will be more certainty about the value of their homes. And it's also important for banks that are holding the mortgages, then they have certainty about the value of the mortgages.
Torsten Slok.
Many thanks.
My pleasure.
Thank you so much, Senior Economist at Deutsche Bank, joining us to discuss housing.